Hello everybody and welcome to this webinar introduced by myself, Ian Fletcher, and I'm delighted to have Andrew Stanley here from Stacks yet again. Andrew, for part two of our capital allowances story. If you missed part one, I think we did it back in February and it'll be in the 2020 archive, so you can re-listen to the initial part of this. I think Andrew may recap one or two parts of that as well. We're going to be here with you for an hour today, folks, and I'm really grateful that you decided to come along and watch this webinar with us during these times. If you've got any specific questions for Andrew, and I recall from February that you will have with regarding various transactions that go through in capital allowances, would you use the question and answer pad? And I will sort of I'll turn my camera off when Andrew's speaking, and then I'll pop in and out with a few questions if that's okay with everybody. So we're talking about capital allowances strategies for sale and purchase, presented by Andrew Stanley. Andrew, welcome back. Pleasure to have you here. Introduce yourself and let's get started.
Yeah, thank you very much, Ian, and good morning, everybody. As Ian mentioned, my name's Andrew Stanley. I'm the Managing Director of Stanley Tax Associates. We are a you call it a tri-brid firm with fusion of tax advisors such as myself, various different flavour, chartered or certified chartered accountants and chartered surveyors. We work in conjunction with other professional advisors, mainly accountants, to assist them for matters related to capital allowances on fixtures. Today, we are going to be having a bit of a look at some of the strategies to be employed when a building changes hands. Even though most of our work tends to be on buildings that are not changing hands, it's that point in time when there is a transaction on the table that people really need advice, and that tends to be when the phone is picked up and we're first introduced to somebody, because it is a bit of a hot potato. And today we're going to run through various different sections to give you guys a bit of an understanding of what the issues are and how we approach dealing with them. And the aim of today's webinar is to leave you with enough information to kind of identify areas of risk and opportunity for your clients. So we are going to, as Ian mentioned, just quickly recap the background, the what, how, and why of capital allowances, which we did the whole previous webinar on. It is going to be the short version, but I'll try to still fill in any blanks for anybody who didn't see the previous webinar. We're then going to have a bit of a look at what the legislative landscape is for capital allowances in a transaction. What are the issues, and then move on from there to some nice, easy strategies, some sort of 1, 2, 3s to follow on what you should be thinking about or putting in place for your clients who are buying or selling. Now, it's quite a bit of content today. I will try to cover it as quickly as possible, mainly to leave plenty of time for questions, but as I always say, nobody's ever complained that a presentation about tax was too short. So, without any further ado, what are capital allowances? Well, to the man in the street, tax allowed form of depreciation. Of course, you have a taxable profit reducing effect through either claiming WDAs or the AIA. So, taxable profits coming down, tax being paid on a smaller figure. Of course, I'm sure you're all very comfortable claiming capital allowances on loose items of plant and machinery, so vehicles, IT infrastructure, furniture, and so on. But it is also perfectly eligible to claim capital allowances on items of embedded plant and machinery. So things like lifts, heating, air conditioning, fire alarms, a whole host of items you can see there in the pictures, and even your plain old mundane toilet. Tapping into the full value for these is not as straightforward as it is with loose items, because often the expenditure on these items during a program of improvements will be mixed in with ineligible expenditure. Now you'll have invoices from contractors that say building work stage 2, £200,000. Well, some of that's eligible and some of it's not. And also these items are more than likely to have been in place when your clients actually bought the building. And they are perfectly entitled to claim on the part of their purchase price that relates to the eligible fixtures. But of course, the purchase price is generally going to be completely disjoint from the sum of the components that make up the building. i.e. you're not buying the building for its rebuild cost. So even if you could identify all the items and you could value them, that's not the figure that you would be claiming in your capital allowance pool, okay? Fortunately, there is a methodology that's been hammered out between our sector and HMRC and the VOA over the last 20, 30 years that allows us to calculate an apportionment of a purchase price. So imagine you bought a building, £1 million. There's nothing in the history, nothing in the purchase documentation that causes an issue. So we know you can make a claim, but we just need to calculate how much that figure is going to be, okay? So what we can do is we go in and we value the replacement cost of everything, from the foundations through to the roof and everything in between. So right down to the type and make of door handles. So we can then, from that huge spreadsheet, identify all the items that we can claim capital allowances on. So imagine that's 25% of the total. And then we also left with all the items that we can't. So the walls, floors, ceilings, doors, all of this sort of stuff. So imagine that's 35% of the total. We now know how much it costs to build the building. We can have a look at what sort of rents it would command in the open market, and we can work backwards to derive the land value for a cleared site with planning permission to build that building on. i.e., what would a commercial entity buy this for, given that they can achieve XYZ return. So in this example, imagine that it's quite high, maybe somewhere in London, 40% land value. So we can now take the part of this ratio that relates to the eligible plant and machinery, the 25%, and multiply that back into what was actually spent to buy the building. So the purchase consideration. So purchase price plus stamp duty plus legals, finder's fees, whatever's been capitalized as part of that transaction. So that was all in £1 million. We're now adding £250,000 across the capital allowance pools, which will reduce the taxable profit. At the moment, obviously, the AIA will allow you to write the whole lot off of its current year expenditure. And that actually equates to £47,500 in current corporation tax, or £112,500 in income tax. So it's quite a large amount of actual cash benefit on even a relatively run-of-the-mill purchase. And that's over 11% for an additional rate income taxpayer, so an LLP or partnership, or even just a high net worth individual. You cash back, if you like, in year one against tax on money that they were going to spend anyway for something that's a statutory relief. Okay. So why should anybody be concerned about this? Well, it's probably pretty self-evident. Obviously, for your clients, it's a potentially huge, uncontroversial tax benefit if they are obviously incurring the right type of expenditure. Our sector tends to be either departments in the Big Four or specialist firms like ourselves, because what we do is extremely relevant to a very small number of your clients in general practice, because most businesses are going to lease their premises on relatively short terms, and therefore not going to be able to claim any sort of meaningful amount of capital allowances on fixtures. But for those trades or investors who are owning the freehold or long leasehold interests or spending a lot of money fitting out, improving, extending, it's extremely relevant. And of course, anything that people can do within the confines of the rules that we have to reduce their tax, especially at the moment, they tend to be pretty keen to hear about. At the same time, hearing about it from you, their trusted advisors, is only ever going to build better client relationships. It's a great differentiating factor as well if you're pitching for business from another firm and the client owns buildings and this hasn't been looked at, because of course it certainly gives you an edge on their offering. What we do, obviously referring us in is all about giving best advice, but we are all businesses at the end of the day. So we do pay a small referral fee for works taken forwards, mainly to compensate you from the fact that it's the amount of your time speaking to your clients about what we do and effecting an introduction. And as we'll see in a minute, there are very serious risks if this is ignored during a conveyance. So that is the short version of the what, how, and wow. What, how, and why. Capital allowances, just a quick note, are, in the eyes of the Capital Allowances Act, available on all types of buildings. Okay, but then dwelling houses are excluded. And dwelling houses are basically your plain vanilla living space, so people's homes or buy-to-let investments. So all forms of commercial property are relevant. So you kind of run-of-the-mill offices and industrial units through to your more exotic things like a zoo or a dockyard. Also, assets that are, in a planning sense, seen as residential but are treated commercially, like care homes or hotels, you can claim on as well. And also FHLs, change how individual residential units are seen. And for furnished holiday lets, so the Airbnbs, serviced apartments of the world, you can also tap into the value. When it comes to larger residential buildings, you've got to be careful because it is a point in question where you've got multi-unit assets. So if you've got a block of flats, with 20 apartments in it, yes, the apartments if people are living in them or their buy-to-lets are out of the picture. However, you can still look at the common areas between the dwelling houses. So hallways, lifts, gym in the basement, reception, whatever happens to be there, car park at the back. The plant and machinery content in these areas can still be claimed upon. And the thing to bear in mind is that if your clients are involved in any one of these sorts of properties, then capital allowances are a crucial feature of the actual conveyance. Now, we had changes in 2012 and 14 that the commercial property conveyancing community are just about starting to get up to speed with. I mean, they've only had nearly a decade to do it, so you can't expect them to move too quickly. So in a lot of commercial transactions now, conveyancers are flagging up capital allowances a hell of a lot more than they were even just 3 or 4 years ago. But when it comes to residential, where people might be buying or selling an FHL or buying or selling a multi-unit residential property, a block of apartments, it is extremely rare for anybody to mention capital allowances, but it's just as relevant for those types of properties as it is for the commercial. So, what is the capital allowance landscape that we have to contend with? Well, first thing to remember is that fixtures are different. There are completely different sections of the Capital Allowances Act for fixtures to what there are for loose plant. Some things are very similar, some things are radically different. They are not to be treated in the same way. The main difference in a transaction is that loose items of plant will be held outside of the bricks and mortar cost, whereas the fixtures are deemed to be within. So you can end up with two apportionments for a correctly structured transaction, where for the loose items, for the chattels, you will have a separate figure in addition to the bricks and mortar purchase price, which generally references to a schedule of those items. So you might have £1 million to buy the building and £20,000 for the furniture, and then there'll be a list in the appendices of what that £20,000 covers, okay? For the fixtures, their value is deemed to be within the bricks and mortar cost. So in that example, you should have the £1 million bricks and mortar cost plus your 20,000 for the loose plant, but then you also need to find out what's the amount within that £1 million bricks and mortar cost, which is for the fixtures. Now, the great advantage of this is that it doesn't impact future capital or chargeable gains. So you're not reducing the base cost by allocating value out of the bricks and mortar cost. It stays within, and in some ways, it's quite a generous area of tax where you can get the short-term benefit through capital allowances, but retain the value to be used against future capital or chargeable gains. There is a restriction on allowable losses if you sell a property at a loss, but beyond that, there's no link between the two. Okay, so the thing to bear in mind is you cannot use the same approach as you do for loose plant for fixtures. So when it comes to additions, disposals, record keeping, it needs to be a separate, at least separately coded, or ideally a separate sheet. If you account for it all in F&F rather than leasehold, freehold additions, that's fine. The tax needs to separate it back out. Otherwise, you're going to end up in some sort of problems at some point.
Andrew, we've got our first question in of the day from Sue. So anybody who wants to ask Andrew a question, please use the question answer pad. It's got an interesting question. It says, should we be advising clients to buy property personally through an personally or through an LLP to get the higher tax rate savings?
Well, I mean, that's obviously straying a bit outside of our area here, and it's dangerously close to investment advice. From a capital allowance perspective, you would receive a greater reduction, but only by virtue of the fact that you're paying more tax in the first place. So there may be a lot of other commercial concerns involved with purchasing something in your own name or an LLP. If you're claiming capital allowances in a corporate shell, then whilst the allowances are there, yes, you're not paying any corporation tax, but you still may have the issue of making a distribution out to the to the shareholders, which is going to be subject to income tax, most likely. That being said, if you're buying an asset in your own name in an LLP, it's great whilst you've got the capital allowances. Of course, they will run out at some point, and when they do, you're staring down the barrel of a 40 or 45% tax charge. So unfortunately, it's often more of a commercial decision than a, put it this way, you don't often see the capital allowance tail wagging the commercial dog. So there is no magic bullet strategy, unfortunately.
Okay, got another one here from Ali. They're coming in now. Can you claim capital allowances on commercial areas such as kitchens on multi-occupancies buy-to-lets?
That's an interesting question, and there is a wide variance in opinion on this. It all depends on the details of the the specific building, but you have to. The definition of dwelling space covers the basic amenities for day-to-day life. So if you've got a 3-bedroom house with a kitchen and a lounge, even though they're all let on individual tenancies, then certainly the kitchen and the bathroom are essential for those rooms to function under the term of dwelling space. So in that instance, I would say no. If you've got a building where you have self-contained bedsits with their own mini kitchens or kitchenettes and ensuite bathrooms, but then there's a large shared lounge, some sort of meeting place, possibly I'm thinking of kind of a student building here, then potentially yes. So it's a matter of scale, really. There are some people out there who will say you can claim it on 3-4 bedroom houses that are let to students and so on. We strongly think that isn't the case. Most of our residential property claims tend to be quite large buildings. We're talking tower blocks and so on, because the percentages involved are quite small, because a large proportion of the floor space is excluded. So if we were looking at a building bought for £400,000 or £500,000, you're only claiming 2 or 3%, it very quickly doesn't become worth the client's time to kind of go down that road, given that at the end they might just save a few £100s. So again, unfortunately, maybe not a definite answer. For us, it's a matter of scale and be able to separately identify sanitary and cooking facilities for the units.
Okay, I've got another question about your example that you've just used, but what I'm going to do is I'm going to suggest that we carry on with the presentation and then stop at another suitable break, if that's okay, Andrew.
That's absolutely fine. And of course, any questions we don't get to answer during the webinar, I'm more than happy to jump on the phone afterwards and just have a bit of a chat with anyone who would like to. So just moving on, the first thing to remember is fixtures are treated differently, certainly when a building changes hands. So let's have a look at an example of what happens when a building, what's supposed to happen when a building changes hands. You've got your £1 million purchase price building. Let's say you bought it 10 years ago you spoke to us 5 years ago. We found £250,000 worth of capital allowances. I haven't split this into the pools or anything, just for ease of example. You've used your WDAs bit by bit by bit, and you've got a tax written down value of the pool at the point of sale of 100,000. So you're selling the building to me. What's supposed to happen is we have a commercial discussion and we fix an effective transfer value for this pool by use of a Section 198 election. Section 198 election can be anywhere from a de minimis value of £1 per capital allowance pool, so in most instances a smallest value of £2, going all the way up to the total amount that's ever been pooled on assets that are still attached to the building. So as long as there hasn't been any major works, you haven't knocked the place down or gutted it, then in this example, that would be the whole £250,000 that was originally pulled, not the tax written down value of 100k. So it's a straight seesaw between the parties. So let's have a bit of a look at a couple of key values here to see what sort of impact it has. So at £250,000, you can see there on the right, you've got an addition to the purchaser of £250,000. So they're happy, they're over the moon, they've got a great outcome. The vendor has the exact opposite position. They have to account for a disposal value of £250,000 against a pool balance of 100k. So of course they get driven into a negative unless they've got other capital allowances there from other activities to absorb it, but if they haven't, it creates a negative, which will then create a balancing charge to the taxable profits, and they will then pay tax on effectively a very real tax on a notional profit of £150,000. So, well, just shy of about £30,000 worth of corporation tax. So not a great outcome for them, unless of course they've got losses as long as you're armed to absorb this into. 100k would take the residual pool balance from the vendor and give it all to the purchaser. And of course, £2 means the purchaser effectively gets nothing and the vendor retains £99,998 on assets they don't even own anymore. And of course, people often say, you know, is this not a bit daft? Is it not abusive? Does HMRC not have an issue with this? Well, of course not, because it's the same amount of jam in the jar. You're just moving jam from here to there. You know, the whole idea of the elections is to make certain that only one total value is ever claimed and that they've got all, some, or none of it is passed down the ownership line. Unfortunately, historically, not many elections were done, or they were done so badly as to be a complete load of gibberish and totally invalid. So it was felt by the then Chancellor back in 2012 that people were double claiming this relief. Deloitte did a report showing that £82 billion was unclaimed in 2011. And of course, Mr. Osborne was all about deficit reduction then. So he probably panicked and fell off his chair. So we then had, in the Finance Act 2012, where section 187A and 187B of the Capital Allowances Act was born. Two key parts to it that are in effect for pretty much every transaction that's happened since the fixed value requirement and the pooling requirement, or mandatory pooling requirement. The mandatory pooling was delayed 2 years so that people get their ducks in a row. But for any transactions happening now, they are both very much with us. So what do these mean? What do we have to do? Well, the mandatory pooling requirement, it's quite literally what it says on the tin. Anything that the vendor to a transaction is entitled to add to a capital allowance pool, they have to add it to a capital allowance pool, else nobody else ever can. Okay, so anything that they're entitled to pool that they haven't, nobody else can ever tap into. Furthermore, for everything that they have pooled, they need to fix an effective transfer value by either one or two mediums, either a section 198 election that we'll go through a bit more details on later, or a decision, a determination in the FTT. Okay, nothing else will satisfy this. No other details in the contract, no sentences saying no capital allowances are available, which is a conveyance's favourite. Something like that has absolutely no meaning in the eyes of this legislation, or even, to be honest, previous legislation as well. So what this means is that you need the vendor to claim everything they're entitled to, and then to enter into some sort of arrangement with the incoming owner. If that doesn't happen, both parties will get the worst possible outcome. And again, we'll come back to this and expand upon the vendor side in a minute, but that means for the vendor, in most scenarios, it's going to be a complete reversal of all historically pooled value on fixtures. So in our example, that's at minus 250, creating the balancing charge of 150,000, loss of 100k's worth of residual pool balance. So absolute disaster on their side. And for the purchaser, they don't even get £2. They get absolutely nothing at all. And that is binding on all future owners. So they have just shot an element of value out of their building from day one. I might just mention on the changes, it's a net gain to the treasury. Just go back a slide actually. Oh. It's a net gain to the treasury on this that they're very much aware of. If you remember, I mentioned there was an £82 billion latent claim out there. This is a huge, so it's tax relief take back by the Treasury, billions of pounds, because of course lots of buildings have changed hands. There's 2 years, by the way, compliance from the date of completion to get this done. So lots of transactions have gone through since 2012 and 14 where there's been no capital allowance advice and no elections entered into. And of course, in all those transactions, any available relief from fixtures in those buildings are being taken out of the market. And there's no official figures on it, but I should imagine it's billions of pounds have been wiped off that latent claim. So it's one of the biggest kind of like tax takes against British businesses. But of course, nobody's complaining about it because very few people actually understand it. Very similar to when Gordon Brown changed the nature of the tax credit on dividends, billions of pounds taken out of everybody's hands. Nobody in the street waving signs because nobody really understood the mechanics of it, the general public. So there's a huge net benefit to the Treasury here that they're very much aware of. And the idea, as we'll come on to now, is to look at how we avoid your clients falling into this and, of course, making that net benefit even larger. So we've got easy strategies all broken down 1, 2, 3. I hope no one's here from Sesame Street, or else we are probably looking at some sort of copyright issues. Josh, our marketing manager, who's on the line, I did charge him with making the subject more fun and accessible. Whether he's succeeded with the by putting the count there, we'll wait for the feedback to find out. But let's look at this from the perspective of one of your clients selling a building. Okay, so the strategy breaks down to 3 parts, really. It's very difficult. In fact, I can't imagine a scenario where it doesn't make sense before sale to review, one, what has been claimed on fixtures, because often you haven't done a big survey, you haven't employed someone like us to do it, there's a good chance there's still been a bit on fixtures that's been added to the capital allowance pool. The £20,000 on the new air conditioning or the new fire alarm, it might be accounted in F&F, but from a tax perspective, it's under this regime. So a review to find out what has been done, what can be done, and of course, if there is an upside to claim it. The reason why it's difficult to imagine a scenario where that isn't a sensible move is because you then have the option to either carry the relief back a couple of years using the amendment window, write down the balance, get the tax saving on the previous years, and at the point of sale, you can either choose to keep it or to sell it on. Because you can either put a Section 198 election in place at £2, which if you position from the outset, is very difficult for a purchaser to push back on. In the marketing particularly to say, we have claimed all the capital allowances and the sales on the basis of a £2 capital allowance election being signed, well, any pushback on that becomes a tough commercial negotiation. Or if your client doesn't have a use for the capital allowances, maybe the business hasn't been great, obviously there's a few that fall into that camp, then the value of the Section 198 can be higher and could be transferred on to the incoming owner. And if you've got a building that costs £1 million with £100,000 of a transferable tax relief, that's more attractive than one that has £0 worth of transferable tax relief. So review and claim, keep or sell, and the key thing your clients are selling is to close off the history. Because the fixed value requirement, if it's not satisfied by either a Section 198 election or a decision of the tribunal, leaves your client wide open to non-compliance risks with HMRC. They can come knocking on the door for a full reversal of anything that's ever been added to the capital allowance pool. And also the purchaser is within their rights, if they're being advised by someone like us, to refer the matter to the tribunal. And the tribunal's view is you've got one party who sold these assets for consideration, and another party that's acquired it for consideration, and therefore why shouldn't the relief go across from one to the other? So the tribunal is generally very good news for purchasers and very bad news for people selling a building. So if you do nothing else, Section 198, even as a defensive, all plant and machinery, which is a very bad form, but it's a hell of a lot better than not having any election there at all. So let's expand a couple of those points. Disposal values for fixtures are different to chattels or loose plant. It's not proceeds driven. There is a table under Section 196 of the Capital Allowances Act that lists 8 or 9 different scenarios, everything from commercial sale to to gift, all this sort of stuff. So every scenario that the drafters of the legislation could envisage. Item 1 is arm's length sale to unconnected party, effectively. So the disposal value that needs to be brought into account is, and I'll read this out, it's a part of the sale price that falls to be treated for the purposes of this part as expenditure incurred by the purchase on the provision of the fixture, or would fall to be treated if the purchaser were entitled to an allowance. So just to decode that for you, that is basically that percentage calculation that we just did a few slides ago on the pie chart, but from the perspective of the purchaser, which makes the disposal value for the seller. So if you claim that 250,000, but I'm buying, and in the previous example, but I'm buying the building from you for £2 million, of course, my 25% of my expenditure is going to be much larger than your 25% of your purchase expenditure from a year ago. So in the rising market, this figure is always going to exceed what has been previously pulled. It is limited to what's previously been pulled. You can't reverse out more than has actually been claimed. But under Section 196, for a vendor, if they don't overwrite this with an election, this is why you have to reverse out everything that you've pulled that's still in the building. Let's just sell in the building at a massive loss, then it might be a proportion of it. So you don't want to be getting on the wrong side of that for the sake of not putting in place a one-page election. So if you're selling a building, even if it's, obviously it's better to take advice, to review and everything as I just said, but if you're doing nothing else, a defensive Section 198 that's got £1 per pawl and all plant and machinery on it is better than having none. I mean, it's potentially still assailable by someone like us, but just simply ignoring the matter is leaving your clients wide open to a whole host of unpleasant outcomes. So what makes a valid Section 198? Obviously it's crucial, and there is a wide variance of opinion of this out there, a lot of them completely incorrect. So Section 198 obviously references to the part of the legislation. You've got 2 years to submit the Section 198 from the relevant date, which in most instances is the date of completion. It could be the exchange if you've got prior possession of the asset. Under Section 201, it lists what needs to be in a Section 198. There is not a pro forma 198. There's been a few suggestions through the work we do with the CIOT, but nothing actually came of it in the end. But the details in 201 lay out what needs to be in there. Now, I'm not going to read out those bullet points. The first 4 don't normally cause too much in the way of any issue. People tend to know who they are, who they're selling to, what they're selling, and so on. Not always, but generally that bit is pretty straightforward. It's the 5th point, the information sufficient to identify the plant and machinery that seems to cause the issue. So what do these guys think is sufficient information? Well, HMRC's guidance says that the rules work on an asset by asset basis. Inspectors may accept a degree of amalgamation where it will not distort the tax computations. So the key bit there is distortion of the tax comps. So if it can be argued that something has distorted the tax comps on the basis of the HMRC guidance, which of course is not legislation, regardless of what they may think, if it can be shown to have distorted the tax comps, the Section 198 is possibly invalid. So what sort of things might distort the tax comps? Well, unsurprisingly, putting fixtures on an election that don't exist in reality is quite easily argued to be a distortion. Now, we don't see this very much now, but a few years ago, it used to be a lot more prevalent, that conveyancers would just put a list of everything that could possibly occur in a building, all items of plant and machinery, attached to the election. So you end up with sort of daft scenarios of lists in one-story buildings, swimming pools in industrial units, and so on. What we do see more commonly, though, is people putting fixtures on the election that they haven't actually added to a capital allowance pool. So Section 198 effectively says that in the positions where you're required to bring a disposal value into account on the, I think it's 1, 2, and 7 of section 196. But basically, if you need to bring a disposal value into account, you can agree by joint election to effectively override that. So if you don't need to bring a disposal value into account, i.e. you haven't added the fixture to the capital allowance pool, it can't go on the section 198, because if you think about it, you're now creating a tax asset on something that didn't exist before. So again, a distortion of the tax computations. The guidance says a degree of amalgamation. All plant and machinery, to me, is more than a degree of amalgamation. I believe it's an absolute amalgamation. Yes, it doesn't need to be war and peace. You don't need to itemize every single thing that's on there, but you're not going to get penalized for doing that. The general consensus and the level of detail that we operate on is at a system level. So expenditure is combined into, say, fire alarms or security systems or air conditioning and so on, so that it gives the reader enough information to understand where the relief is coming from, or what sort of things have or haven't been pulled. And of course, don't mix it all together. Your loose items should not be on the section 198, and your fixtures should not be on a separate contract apportionment. Not only is this potentially invalidating your section 198, but it is also distorting capital gains calculations, potentially it is engaging in some form of stamp duty avoidance at best, because you're messing with figures like the purchase price and so on that have all sorts of other ramifications as well. But you're certainly invalidating your section 198. There's two capital allowance pools. We don't mess around with pence in tax. So the smallest value that should be on most elections would be £2, not £1. There are a couple of unusual exceptions to this, but generally it's £2. So if you've got everything lumped together, in just one pool, it's a mistake. Elections should be written in the eyes of the legislation on the day of the relevant transaction. So it's effectively from the purchaser's perspective. So you have what the purchaser have the main pool and what might be the special rate pool for them, which might be different to the seller, because of course they may have been under different rules when they actually incurred the expenditure. But that's a job for them to trace that back. Or you could go for 4 tables, which is main pool in the eyes of the purchaser, special rate pools in the eyes of the purchaser, main pool in the eyes of the vendor, special rate pool in the eyes of the vendor. But at a minimum, it needs to be from the perspective of the acquirer, and that's why it's today, because we're post 2008, obviously by a couple of years, the minimum value is £2, not £1. And details. I mentioned the first 4 things on the list don't generally cause too much issue. We have seen people get it wrong. Generally where there are details left over in pro formas from the conveyancers from the last transaction, and you've got people signing elections that have got the details of a different property in. Now, you don't need to be a capital allowance expert to know that that election is a complete load of rubbish and can be put in the bin. Now, the risks you have with making an election invalid is that you're giving ammo to potentially a HMRC inspector saying, right, well, in that case, then you need to apply your disposal value in line with section 196, or for a purchaser, if there was value in the election, you can't have this because the election's invalid. The main risk is that if you're putting in place an invalid election and you're selling a building, the purchaser will be advised by someone like us, and we will use it to effectively open the door to refer the matter to the tribunal for a decision. And as I said, that's generally very good news for the purchaser and very bad news for the vendor. So that's the simpler half of the process. Strategies for purchasers get a little bit trickier. Bottom line is that it takes 2 to tango when you're buying a building, because you can't just brush it under the carpet and deal with it later. So what is the 1, 2, 3 strategy for purchasers? Well, info, new legislation, claim and transfer. So let's expand these a bit. Information. The main source of information you're going to get during a conveyance if you're buying a building are the CPSEs, the Commercial Property Standard Inquiries, of which in there is a capital allowance section. If it's a residential transaction, then questions will need to be asked directly solicitor to solicitor to get a handle of what's involved. I don't know if many of you guys have seen the CPSEs before, but you tend to get one of 2 extremes. Not always, but most cases fall into 2 kind of camps at either end of the spectrum. Either you've got a very well-informed seller who will put on there, we have claimed all the plant and machinery and you're signing a £2 election. Yeah. At the other end of the spectrum, you're going to get a lot of question marks or not applicables, or not sure's, smiley faces drawn on there, which shows that the person who's selling the building is completely unadvised in this area and probably doesn't even have an idea of what capital allowances are. My favourite is the first question in the section says, is it held as a fixed or current asset? When somebody responds neither, then you've got a real sharp cookie on the other side of the transaction. So the next thing to move on to from there, once you've verified you've got the knowledge level of the other party and what they have or haven't done, is to ask yourself, is the new legislation, by this I mean the 2012 changes, so probably not that new anymore, but the 2012 mandatory pooling and fixed value requirement, are they in effect? Okay, because the fixed value requirement follows from mandatory pooling. So you have to fix value, you have to put a transfer value for anything you've pulled. If you are unable to pull some things, then they can't be under mandatory pooling, and therefore there is no fixed value requirement on it. So if the person selling the building is a pension, government body, charity, or some other entity that's precluded from claiming capital allowances, then mandatory pooling is not in effect, and therefore there's no fixed value requirement. So you're very likely to be walking into a scenario where you, as the new owner of the building, can simply claim the whole lot as a percentage, obviously with some survey work and so forth. But you need to bear in mind, if that particular entity bought the building after 2012 or 14, there may be restrictions on them on the way in that carry on to you on the way out. So we would always check the history all the way back to 1996, which is the raw assent date of effectively the precursor to Section 185. To see if there's any sort of spanners in the works and to see who's under what bits of legislation and what they can or can't claim. So sometimes you may have a £2 election in place which covers all but not some of the plant and machinery, because the vendor may not have been entitled to claim some of the plant and machinery. So that might block a claim on a lot of the items, but there may still be certain things, and it's mainly the 2008 pre-commencement table features, because before 2008, you couldn't claim electric lighting, general power distribution, and cold water in most instances. So if your vendor bought the building before then, they had no entitlement to claim those items. Therefore, it can't be under mandatory pooling and it can't be under the fixed value requirement. So worst case scenario, your client buying the building now can at least do a small top-up claim on those particular systems. So is the new legislation in effect? Seems like a very simple question, but often it's a long way from it. And again, you wouldn't want to forge on with a strategy without having a clear understanding of the history of the building, which is all available from our registry, because you may be putting in place certain, the conveyancers may be putting in place certain clauses, when actually you need certain other clauses. For a purchaser though, if mandatory pooling the fixed value requirement is in effect, your general strategy is some form of claim and transfer. Okay, so this means clauses going into the sale and purchase agreement that broadly state that the purchaser will pool all of the relief your advisors find, normally us, well hopefully us, and then they will assign it across in its entirety by Section 198 election. Now, all of that can be done after completion. You've got 2-year compliance window, so plenty of time to get the work done, but you would want to get the other party's commitment to it during the conveyance, because of course that's when your client who's buying the building has got leverage. We want these clauses in here because we're buying the building. It's of no detriment to the other party, because as we'll see in a minute, they end up back where they started. But it's a lot better addressed as early as possible, because of course after the fact they have no reason to help you. And even the nicest person in the world, they're going to want a slice of the result, even maybe 50% of the allowances or some sort of cash payment for doing the claim and transfer. So I suppose in an ideal world, we would always be brought in before exchange of contracts. But the reality is that a lot of your clients will phone you up and say, hi, I bought a building 6 months ago. What's your advice? And of course, it would be great if you could jump in your time machine and go back in time 7 months and give me a call then. But it can generally still be repaired after the fact, but it comes down to some sort of commercial arrangement with the previous owners. So just to maybe go through this again with some numbers, just to help put the general strategy across. Just imagine you've got your £1 million purchase price building again, okay, being sold to this chap here. Now, nothing's been claimed capital allowance wise so far. So claim and transfer clauses go into the sale and purchase agreement, of which we can provide examples to conveyancers for them to be inspired by to put into contracts. We don't write contract clauses, of course, we're not solicitors ourselves. But as those clauses have gone in, the deal's gone through, we've gone in after the fact, surveyed the building, collected information from the purchasers, from the vendors' advisors, and we've come to the conclusion that £250,000 can be added to their capital allowance pool. They then enter into an election for £250,000, which is minus £250,000 in their capital allowance pool, which means the two net out, leaving them absolutely neutral, and giving £250,000 for the capital allowances to your client who's just bought the building. It seems convoluted and a bit of a drawn-out process, but actually it's not really that involved for the vendor, beyond providing a bit of information during the conveyance that they're generally providing anyway, and then signing the election once we've prepared it. And in most instances, this is the only way that someone buying a building can tap into the capital allowances. We have done, I don't know if it's thousands yet, but we've done a lot of these over the years. And fortunately, we have found that once people have committed in the clauses in the sale and purchase agreement, it's extremely rare for anybody to try and not sign the election after the fact. We've had a few kind of wily characters who are trying to negotiate a little bit from them. Because of course, during the process, during the conveyance, we haven't said, oh, we think there's £250,000 worth of untapped tax relief on your building. Because people tend to go, thank you very much, we'll go and claim that. So we very vague figures. The clauses will talk about entirety and so on. So when you see the figure at the end, a few times people have tried to reopen negotiations, but the vast majority have simply signed the election because they've already committed to do it in the very enforceable sale and purchase agreement. Now, these claim and transfers come in 3 distinct flavors. So you've got your plain vanilla claim and transfer, which is when you're buying a building from somebody who's entitled to pull the capital allowances that haven't claimed sausage in the past. So as in the diagram above, they're adding the whole lot in and deducting the whole lot out. You've then also got what we call an excess claim and transfer. So often when you see those CPSEs and they say, we've claimed everything, you're signing a £2 election. A lot of the time people say, okay, well, that's the matter settled. We would always push back on that and say, okay, that's fine. We're not necessarily going to say that isn't the case, but can you just provide us the details of what you have actually added to the capital allowance pool? Because a lot of people out there think they've made a full claim, when in fact, all they've done is scratch the surface. And what they mean is they claimed that £20,000 on the new air conditioning system, but have missed out on the £250,000 on their purchase price. So once we can verify that, we can say, okay, that's fine. Well, we'll section 198 off what you have claimed, but then anything above that, you add to the capital allowance pool and transfer across. So in this example, if there was £20,000 of a previously pooled value on the air conditioning, they would then be adding £230,000 to their capital allowance pool and then entering into an election for £230,000. So they would still get their history closed off. They got exactly what they asked for. Their £20,000 on air conditioning is safe. But the excess, the amount above what they have claimed and what was actually entitled to, has gone across to the purchaser. So we do quite a few of them as well. And obviously, it's a great door opener to then speak to their advisors and so forth about, after obviously the instructions finished, about maybe we could give you a bit of slightly more robust input on capital allowances. Now, the third variant is what we would call the hostile claim and transfer, which is where I think it's a case of a little bit of knowledge can be a very dangerous thing. To be able to refer a matter to the tribunal will then fix a determination of what effectively the election value would have been. They can't force somebody to actually pull that value in the first instance. So unless you've got verification on what's in the pool, as a purchaser, there's no point taking it to the tribunal, because you may just get a pointless decision that says, well, if they did have this in the pool, they would have to transfer it. but if they haven't, or you can't verify it, of course, HMRC is not going to let you just stick it in your capital allowance pool. So a hostile claim and transfer is where the vendor provides information that shows that they have put items into a capital allowance pool during the conveyance, and then after the fact, that is used as leverage to effectively get them to sign an election, or it's referred to the tribunal. So it's what we call the perfect worst hand. So if you take nothing else away from today, take some notes on this and be very careful not to be the advisor who walks straight into this, because it's an absolute disaster for your clients if they do it. So there's a real life example here, by the way, I'm going to give you, of the worst way to handle a commercial property sale. So our client, the buyer, was buying a care home in Essex for £5 million from a large care home group, hundreds of millions of pounds worth of assets on the balance sheet that really should have spent more money on their conveyances. So their vendors sent our client, so the vendor solicitor sent our client's solicitors a nice detailed report compiled by Deloitte's capital allowance team showing that when they built the care home, they added £1.3 million worth of capital allowances to their capital allowance pool. So mandatory pooling, big tick. We know £1.3 million has gone into the capital allowance pools. They then proceeded to not mention capital allowances ever again. There's no clauses in the contract, no section 198 election put forward, nothing at all. We told our client to play dumb. This obviously comes more naturally to some clients than others. But by this, we meant that if they don't want to put any capital allowance clauses in there, we don't want to put any capital allowance clauses in there. So if any do turn up, of course, give us a shout. Otherwise, let it go to completion as it is, with no mention of capital allowances in the actual contract. This then meant that post-purchase, in absence of a section 198 election, we could refer this matter to the first tier tax tribunal for a determination on behalf of our clients. We had to go in, do the survey work, calculate what their allowable figure would have been, then limited to the 1.3 million. Surprise, surprise, our calculations came up above the 1.3 million. So our case, the FTT was saying that the value should be 1.3 million pounds worth of capital allowances. We were then contacted by their auditors. They changed to Pricewaterhouse at that point, who said PwC about 15 times in the first minute. I don't expect us to scream and run out the room or something. We didn't. We turned down their offer to settle, but then they came back with a much more sensible offer, which our client wanted to accept, of 1.17 million of capital allowances. The reason why he wanted to accept it is, those of you who have been there, anything with the tribunal is not an overnight process. And of course, any sort of action like that is never certain, can rumble on for ages, people can appeal, all sorts of things. So he felt the 1.17 in the pocket now was better than 1.3 maybe a year or two later. So the cost to the care home group of not putting in place a one-page section 198 election was £234,000 in corporation tax through lost capital allowances. So not knowing the legislation and the landscape can be very costly indeed. And we actually phoned up this care home group after our instruction had finished and said, well, we think someone's dropped the ball here. Would you like our help finding out who it is? So you can maybe test their insurance for a negligence claim. And their response was that there's no need to, we already have it in hand. So on that front, whose liability is it? We touched on this in the last webinar as well. Again, this is going to be a short version of this, but the bottom line, my reading of the case law is certainly for commercial transaction, it's the conveyancers, okay? However, they are a long way from daft when it comes to matters of liability. And of course, they turn around to their clients and say, this capital allowances are important. You need to speak for accountants. And they pick the phone up and they phone you and say, I've got these CPSEs, I've got this election thing, what's it all about? Do we need to worry about it? And what you say next will make a big difference as to whether it's your neck on the block if things go wrong or the conveyancers. And often in these scenarios, you can end up taking on board the duty of care and giving advice, often without realizing it, and certainly without getting paid for it. So if you do get a call like that, you need to just take a second to make certain that you have a full understanding of the transaction, the risks involved, and so forth. And of course, if you don't want to do that, you may have other things to do, and of course you can pick the phone up and give us a shout. So quick recap for you. I hope we've covered enough now for you to understand what it is that we are talking about of our area of capital allowances, the kind of landscape you need to contend with, and hopefully a few practical things that you can take away and employ when speaking to your clients, and also so that you know where the real big risks are and when possibly it's worth picking the phone up to ourselves. I should have mentioned we've got another webinar. Sorry, the date's been pinned down yet, has it, Ian? But we'll be talking the more exotic side of capital allowances later in the summer. So things like structures and building allowance, land remediation relief, the RDAs and so forth. That'll be coming your way soon. So if anything is kind of caught your ear, or saying, oh, I've got a client who's involved with this, or a client who's phoned me recently, what should you do? Well, contact us, give us a call, ping us across an email. We only have a charge at the end of the process as a percentage of what we deliver. We don't charge anything at all, just for looking at something, giving you some pointers, helping the clients to protect their position. Of course, we'd like to be in the running for the survey work and the claim. That's obviously our business, but we're always happy to have a bit of a look at something and give some advice. So,
Andrew, thank you so much for that. I'm just launching a poll while we do this because I found that fascinating, and also I made a note that we should focus on our area of expertise as accountants rather than some of the stuff that I was listening to there, which is obviously your area of expertise. And it's I thought that was a very interesting webinar indeed. I've got a question in from Anthony, but I think it's one of those that you should probably talk to Anthony direct rather than through the webinar. And if anybody has got any further questions for Andrew today, please make sure that you get in contact with him. So the poll here is very interested, somewhat, not interested, I'm already a client. So if you could complete that, that would be great. And let me just finally turn over to Andrew for the final words of wisdom on today's webinar, Andrew.
Well, I think as you've probably got a bit of a feel for, there is no magic bullet strategy. What we've covered is just the tip of the iceberg. Every scenario is unique. It's very difficult to bring it all together in a 1 hour webinar. So apologies, it's maybe covering a few too many different topics. The bottom line is you shouldn't react too quickly in this area. If you're being asked for your opinion, you need to do your homework, to get a firm handle on the situation, and then ask yourself, is this something I'm comfortable answering? And if you're not 100% comfortable, tax is not an area to just have a go. As I said, we're always happy to just give you. We spend a lot of our time advising the advisors. Always happy to give you, pointers on what you should be saying, even if it's just for for your peace of mind. So the bottom line is be very careful in this area, because if you get it wrong, there's a very big stick in this area, as well as the carrot, and your clients could suffer substantial financial loss, which is not a scenario anybody wants to be in.
Fantastic. Okay, well, thanks everybody for joining us today, and Andrew, thank you so much for your excellent presentation as always. We look forward to the next one when we'll go into some more murky bits, I guess, of capital allowances. So thank you so much for this, the second in the trilogy of capital allowances. It's almost like a film, isn't it? And if you missed the first one, you can watch that in our webinar archives on the 2020 website. Andrew, everybody, thank you so much indeed. Take care, everyone. Stay safe. We'll see you soon. Thank you.
Thank you. Take care. Bye-bye.